Welcome to the next video in the budgeting series. I'm Val, and today we're exploring whether you can truly make investment decisions relying on methods like moving averages, Elliott waves, and Wyckoff theories. Let's get into it. Investing is both an art and a science, and there are countless strategies out there. Among the popular ones are moving averages, Elliott waves, and Wyckoff theories. But can you rely solely on these methods to make sound investment decisions? First, let's talk about moving averages. Moving averages are used to smooth out price data to identify trends over a specific period. They help investors understand the direction of the market. While moving averages can highlight trends, they are lagging indicators, meaning they reflect past prices. Relying solely on them might cause you to enter or exit trades late. Next, we have Elliott waves. Elliott Wave Theory is a form of technical analysis that identifies recurring wave patterns, which can predict market direction. This theory can be useful, but it is also highly subjective. The interpretation of wave patterns can vary from one analyst to another, making it less reliable as a standalone method. Lastly, Wyckoff theories focus on market cycles and investor behavior. Wyckoff's approach includes phases like accumulation, markup, distribution, and markdown. While this theory provides valuable insights into market psychology and trends, it requires a deep understanding of market movements and context. So, can you rely on these methods alone? The answer is, it's risky. Each method has its strengths, but they also have limitations. Here, what you can do. Number 1, combine methods. Use a combination of moving averages, Elliott waves, and Wyckoff theories to get a more comprehensive view. This can help confirm signals and reduce the risk of false positives. Number 2, fundamental analysis. Incorporate fundamental analysis to understand the intrinsic value of the assets you're investing in. Look at financial statements, industry trends, and economic indicators. And number 3, stay informed. Continuously educate yourself. Markets evolve, and staying updated with new strategies and tools is crucial. Remember, no single method guarantees success. Diversifying your strategies and staying informed will put you in a better position to make sound investment decisions. Thanks for tuning in. If you found this podcast helpful, be sure to subscribe and share it with your friends. Until next time, invest wisely and stay informed.